Financial language can feel confusing and overwhelming. In this video, we'll explain common financial terms in plain English, using simple examples. Understanding financial terms helps you understand what questions to ask and what decisions you're being asked to make. Before we begin, this video is for general information only and does not constitute personal financial advice. It does not take into account your objectives, financial situation, or needs. You should consider seeking independent professional advice before making any financial decisions. Simple interest is interest calculated only on the original amount. For example, if you invest $1,000 at 5% simple interest, you earn $50 per year. After 5 years, you earn $250 in total interest. Compound interest is interest calculated on both the original amount and the interest already earned. For example, $1,000 at 5% becomes $1,050 after 1 year, and in the second year you earn interest on the higher amount. Loan-to-value ratio compares the loan amount to the value of the property. For example, a $400,000 loan on a $500,000 property equals an 80% loan-to-value ratio. Mortgage insurance, often called LMI, stands for Lender's Mortgage Insurance. It is usually required when a borrower has a smaller deposit and the loan is considered higher risk by the lender, commonly when the loan-to-value ratio is above 80%. Mortgage insurance does not protect the borrower. It protects the lender if the borrower cannot repay the loan and the property sale does not cover the debt. The cost is often paid up front or added onto the loan amount and can run into thousands of dollars depending on the loan size and deposit. A credit score reflects how you have handled credit in the past. Paying bills on time and keeping debts under control improves your score, while missed payments and defaults reduce it. A variable rate can move up or down. A fixed rate stays the same for a set period. A split loan combines both, such as fixing half the loan and keeping half variable. If you have $20,000 in an offset account, interest is calculated as if your loan were $20,000 smaller. Redraw allows you to take out extra repayments you have already made. An investment property is purchased to earn rental income. An owner-occupied property is the home you live in. The same house can be either, depending on how it is used. MARE stands for Management Expense Ratio. It is the annual fee charged by an investment fund. For example, a 1% fee on $10,000 equals $100 per year. Balancing a portfolio means spreading money across different types of investments, such as shares, property and cash, rather than relying on just one. Top-down investing starts by looking at the economy and industries before choosing companies. Bottom-up investing starts by analyzing individual companies first. A buy-sell spread is the difference between the price to buy and the price to sell an investment. For example, buying at $1 and selling at 98 cents represents a cost. A review means checking whether your financial arrangements still match your goals. This is often done yearly or when life changes, such as a new job or a family change. Income is the money you receive, such as wages, business income or rent. Expenses are the money you spend, such as living costs, bills and loan repayments. Understanding the difference between income and expenses helps people see whether they have a surplus or a shortfall each month. Cash flow compares money coming in with money going out. For example, if $5,000 comes in and $4,500 goes out, there is a surplus, T. An asset is something that can grow in value or produce income, while a liability is something that costs money or creates debt. Net worth is calculated by subtracting what you owe from what you own. For example, $600,000 in assets minus $400,000 in debt equals a net worth of $200,000. Inflation is the increase in prices over time. For example, something that costs $2 today may cost $3 in the future. Lower risk investments like savings usually have lower returns, while higher risk investments like shares usually have higher potential returns. Diversification means spreading money across different investments so that performance does not depend on just one area. An interest-only loan means repayments only cover the interest charged, so the loan balance does not reduce. A principal and interest loan means repayments cover both interest and part of the loan, so the balance reduces over time. Different loan types affect cash flow and how quickly debt is repaid. This content is provided for general information only and does not constitute personal financial advice. TruePath Finance Australia exists to help Australians understand how the financial system works, in plain English. If you found this helpful, consider subscribing for more general education like this.